Hey everybody, welcome to DLA Markets, and this is DLA Markets Week in Review. All right, so it's a beautiful day out here. I thought I would do this Friday update, which I started last week, and I said I would try to do it as much as my schedule permitted. So today, since it's such a beautiful day, we're doing it from poolside, okay? We're rocking it poolside, baby, okay? So really, seriously. So this week, we have another week where the markets, all the major indices are down. Continued volatility, both in the stock and the bond markets. We saw excessive volatility in the bond market. We saw credit spreads blowing out, which indicates that the markets are getting concerned not only with interest rates rising, but also with the credit situation. Okay, which I've been warning about for a long time, that with inflation at the levels that we're seeing now, and with interest rates rising, and the potential for demand destruction, and the increasing costs that every corporation is concerned with now, you're going to get margin destruction, and I think the market is finally starting to focus on this. But anyway, I digress. Let's get into the major takeaways of this week. I think if I had to focus on one thing, which is the most major takeaway from this week, it arose from the Fed's announcement of further increase in the Fed funds rate of 75 basis points. Now, if you recall, this 75 basis points was really a reaction to the market, okay, because everyone was talking 50 basis points before you saw the volatility last week, and then there was a leak from the Fed that said they were considering 75, and then it became consensus. Everyone was expecting 75. So the Fed kind of put itself in a position where if they didn't raise 75, that would be a problem, because the market would think that they weren't serious if they just did 50. So in fact, they came out, they did 75. There was a relief rally right after the announcement, and then on Thursday, there was a fairly deep sell-off, and then today, the market was just sort of up and down, but not down really that much. So week over week we had a modest decline, but I think the main takeaway now, and I'm hearing this more and more and more, even though I have been talking about this for months and months and months, going back 6 months now, I think people are basically concluding that the only way the Fed can fulfill its mandate and bring inflation back down to 2% from 8.6% where it is now is to essentially crush the economy, okay? I'm saying crush the economy, decrease demand, whatever you want to call it. They're basically, well, there's a perception anyway that the only way they're going to be able to do this is to crush the economy. Now, this has had a bunch of effects associated with it, okay? One is people are starting to realize and starting to acknowledge that with, overall earnings at basically 16, 17 times backward-looking earnings, right? Because forward-looking earnings are bullshit, right? Because people, just make up their earnings projections, and they're either right or they're wrong. But one thing that is a fact, you can look backwards and see what the earnings multiple is. And right now, it's between 16 and 17%, okay, on the S&P. That's on the overall market. A lot of people are beginning to realize, goes along with what I think, is that levels have to come down from here and be actually significantly below the average, which is around 17. They've got to be below the average, and the market has got to get massively oversold before we're going to hit a base where we can rally again. And that would also, I would argue, would also have to, for it to be sustained, right? Because we do have bear market rallies. and very significant bear market rallies. But in order for the market to form a base and go up, you would also need the Fed to change its stance from its current tightening mode, where it's reducing liquidity and raising interest rates, to where it perceives that it damaged the economy maybe too much, and now it's going to loosen monetary policy and try and stabilize things. That's when you will see a base formed and the potential for the market to go up. And I've said on this channel, I'll reiterate it here, that I'm looking to the VIX. The VIX has been in and around 30, got up as high as 33. The VIX really has to get to 40, 50. And during the financial crisis, it hit 80, okay, to show how bad it was. But it's got to get way up higher than it is here for this capitulation and this panic selling that you would need to see in order for the market to form a base and just really remove every single bull from the market. Once that happens and everyone is uniformly negative, then we have a chance that the market will stabilize and go up. But until that happens, I would use these bear market rallies to sell your losers, raise cash, and you can be a stock picker, of course, but overall, do that within the context of expecting that the overall market is going to go down further from here with rallies interspersed. Okay, a couple of the other key things that affected the market this week was retail sales went down 0.3% as compared to April. Also, we're seeing softness in the housing market take effect, all right? The NAHB, which is the National Home Building Association, reported that their index went to 67 from 69. That shows a weakening in their sentiment in terms of home builders' sentiment, which is reflected in fewer home starts and sales going down. Existing sales of homes is also going down. This is reflective of the increase in mortgage rates, which this week hit 6%. Now, this is very high even compared to a year ago, where rates were as low as 4%. The 30-year rate was as low as 4%. So this dramatic increase in mortgage rates, I believe, is going to significantly crush the housing market. Okay, I think one of the other takeaways that I see is that now, and again, I've been talking about this for 6 months, but now people are beginning to realize that, number one, the Fed is serious, okay, about raising interest rate and draining liquidity and cooling off the economy. And B, out of that, people are beginning to realize that, yes, we are going to go into a recession, because there's no way that the Fed can fulfill its mandate without putting the economy into a recession and raising the unemployment rate, okay? And so I think people are finally beginning to realize this. It's finally becoming consensus in the market. You can see it in all the commentators on TV and things of that nature. People are beginning to realize it, okay? The other thing I found very interesting this week is the realization among many people related to crypto, okay? And I've done a couple videos on this channel. I haven't really focused on crypto, but I have done a couple of videos which you should check out on the channel. But crypto, I think people are concluding that the majority of the crypto market is the purview of hucksters and con men, and you can draw a couple conclusions from all the price action that we've seen over the last couple months in crypto, right? One is, it's not a store of value. Okay, everything that the hucksters and the promoters were telling you to try to loosen up your wallet and get you to invest in crypto so they can make fees is all complete bullshit, right? Okay, It's not a store of value. It's not an alternative to gold, okay? And it's not a hedge against inflation. All right, that one was the most ridiculous, absurd claim that they could possibly come up with. And I guess the fourth one and related one is that it's not an uncorrelated asset class from the stock market, okay? It's 100% correlated to thinly capitalized growth stocks that don't make any money, okay? It's 100% correlated to that. And so people are beginning to realize that most of the quote investments in crypto are nothing more than Ponzi schemes. There's no value, okay? And I really feel bad that a lot of, I'll call them unsophisticated, not that they're unsophisticated people. I mean, they can be extremely intelligent people, but they're unsophisticated with respect to investing, and they've been conned into, you know, Terra USD, Dogecoin, or I guess are the two best examples of things that have completely and utterly just crashed and practically gone away. I mean, Terra USD, $85 billion of people's wealth, you know, went up in smoke, basically vanished behind basically a Ponzi scheme that where the fundamentals, once the market turned south, basically did not work. It was based on a theory that was total BS. All right. I looked up a couple data points. I mean, Bitcoin from its high is down 70%. Okay, 70%. This is in line with many growth stocks that don't make any money, right? Highly speculative stocks that were blown up in the speculative frenzy and have now just completely cratered. Solana, which, believe it or not, was one that I was looking at, which is supposedly like the new latest and greatest Ethereum, right? That is down 91%. 91%. And Ethereum itself is down 77%. Okay? You know, when I look at some of the smartest people on the planet, and Zell just came out this week saying that he sees absolutely no value in crypto. And he admits he doesn't understand it, all right? But he sees absolutely no intrinsic value. Okay, now Zell's one of the smartest people on the planet in terms of investing, okay? Warren Buffett and Charlie Munger. And I've done videos on this channel with them speaking, not me, them speaking, where they say it's rat poison, it's the purview of hucksters and promoters, you know, it's an example of speculative excess due to all the money printing, and there's no intrinsic value. Warren Buffett famously said, if you gave me all of Bitcoin, every Bitcoin that exists for $25, he wouldn't take it. All right? Now, the other thing that was interesting, which I read this week, is that Bill Gates, right? Pretty bright guy. I don't agree with everything he says, and I probably don't agree with a lot of the things he says politically or whatever. I don't care. It doesn't matter. But Bill Gates said that crypto operates under the greater fool theory, meaning that the only way it operates is that you're betting that someone will pay more than you to take you out of it and to see any kind of a gain, you know, implying that there's absolutely no intrinsic value in any of it. All right. That doesn't mean that I think that blockchain technology doesn't have, you know, bona fide uses. Of course it does. And I think there's a lot of potential there in financial transactions and the ledger system that it employs and all that. I think it's great. I think the technology of it is great. But as an investment, I think what we're beginning to realize, and if you're heavily in crypto and you still have any money left, I would seriously look at this and don't expect it to come back anytime soon, because the Fed's not printing money anymore, guys, okay? Liquidity is drying up, not increasing. And the times when you saw the greatest increases in the crypto market were the times in which the Fed and the government were just flooding the market with liquidity. The money had to go somewhere, and it went into speculative assets, and that's when you saw the increase. Don't expect that to repeat itself in the next year or so, because it ain't gonna happen. Okay, in my opinion. I could be wrong, but. And the last thing I wanted to talk about, because this really relates to this channel, is energy. Okay, we've been heavily invested in energy. I personally have been heavily invested in energy. I've done it with the integrated oil companies, Exxon and Chevron. And actually last week, and I'm going to put, well, I'll put it up here. I'll put up the video that I did last week up here at the end of this video, so you can take a look at it. I did a video on Exxon hitting when it hit 100, right? Because I'd been predicting for a year or so that it was going to hit 100. It finally hit 100. And I said on that video, at the time I did the video, it was trading at 104. I said, do not buy it here. Even though I'm bullish, even though I continue to think the setup is great for energy and for Exxon in particular, I said, do not buy it here. It's massively overextended. Wait for the inevitable sell-off, which these energy stocks always do. And sure enough, this week, you know, along with the Fed's announcement, and you know, people realizing that the economy is going to go down, it started selling off, and it sold off 17% since I did that video. Okay, so now if it keeps going like this, I'm going to be putting out another video that's going to say buy the dip. Okay, but I'm still evaluating if we're there yet. Okay, still bullish on energy. Okay, I think you really have to understand the fundamentals of what's going on in the world right now to understand how completely bullish I am on energy. And also I've done a lot of content on the Guyana discovery as it relates to Exxon, and you should really check those videos out. I'll try and put them in the description below. Actually, I'll put one up here. I'll put the recent Exxon over here, and I'll put the Guyana, the most recent Guyana one up here, so you can check it out. But you know, that's going to be worth hundreds and hundreds of billions of dollars to Exxon, and it's going to happen fairly soon. And the break even on that discovery is between $25 a barrel and $35 a barrel. So it's going to be insanely profitable to Exxon. But you know, when people begin to realize that the economy is going down, it's just natural that people would sell energy. Okay, and you know, quite honestly, there's going to come a point, depending on how bad the economy gets, where I might sell, you know, part of my Exxon holding. At that point, I would be making a fundamental decision: is this something I'm going to own like forever, or is this something that, you know, basically the ride's over, and I see other opportunities, you know, that kind of thing. The other thing I really like, and the other thing, you know, I've talked about on this channel as a way to sort of stock pick your way through this horrible market, this bear market, is I really like Google. Okay, Alphabet, and I just initiated a position this week. There's another thing I did. I initiated a position this week in Alphabet ahead of the 20-for-1 stock split, because I think that once the stock splits 20-for-1, number one, I'll get 20 shares for every one I own. But in addition to that, I think that it's going to dramatically increase the liquidity and the demand in the stock once it splits and you're down to, you know, $116, $120 a share. A lot more people can afford it. A lot more people can buy more shares, and I think it'll open up more retail investment, as opposed to when it's, you know, $2,200, $2,300 a share. Not many people can go in and buy a meaningful number of shares at that price, and that's why they split it. But Google is a fantastic business, and I would say check out the channel on the one that I just did about a month ago on the 20-for-1 stock split and the opportunities I see there. Okay, so anyway, to wrap up on this, it was a fairly wild week. You know, fueled by the Fed's announcement, I think it's changed a number of minds in a number of different areas, and I think that again, the market blew through a number of its support levels on the S&P, the 280 that I talked about on the QQQ, and so I think what you're going to see is continued volatility. You're going to see rallies within the bond market. You're going to see rallies within the bear market, right, as you always do. But I think you're going to see continued volatility, and I think the market still has a significant ways to go. Again, keeping your eye on that VIX, before you're going to see a base, and before you're potentially going to see a change in Fed policy that would argue that we'll go back into a bull market. All right, so I hope you enjoyed this. If you got value out of it, please like and subscribe. I'd like to have you on board, and hit the bell too. I'd like to have you on board so you can get notified every time I come out with videos. As I said, I'm going to try to do this update once a week on Friday to the extent I can. And we're going to be coming out with some great content on these and related matters very shortly this coming week. So stay tuned. And for now, this is Greg out.